startups comes to me and say, "Ki, why do I need financial planning? I just give me funds and I'll just invest in. Just work, let me work on my idea. I want to work on my idea, don't want to manage finances." But it's because actually they are not able to understand the numbers and finances. So understanding finance is very tedious task. So you generally go to your first CA or a financial expert and tell them whatever you want to do. But it's not just that. So there's a difference between accounts and finance. Accounts is your past, whatever has been done in terms of compliances, GSTs, income tax, and multiple things and all. But finance is your future. Whatever has to be done in future, where the money will come from which source, who will spend, how it will go, how the cash will come, what is the pricing and all. There are many aspects to it. So that can be done by you yourself as an owner, because you know each and every aspect of your business. So rather than just starting out your business, you should also understand numbers much better, so that you are able to get those your business to the next level, to the 10x level, or you make your business a successful business model. But tell me, so why you need financial management? Because there are two major aspects. Whenever you need funds, you have those funds. And your funds, once you have, those resources are not wasted out of it. Just take an example. If you are you have made a plan that you need 10 crore rupees for certain aspects and all. Then what happens is, you get 5 crore rupees, okay, you believe, I've got 5 crore rupees. And now from that 5 crore, rest 5 crore will also be, let me spend this money first. But what happens at the end of 5 crore, you are not able to raise more, and your business is down. So as a financial management, the most important aspect is to understand, if you are raising 10 crore and you receive 5 crore, how you have to manage within that 5 crore. And the otherwise also, if you are raising 10 crore rupees and you receive 20 crore rupees, how to manage that? Otherwise, you are not able to give that ROI to your investors. Then also you'll do the wasteful expenditure in those businesses. So that's why major aspect is to understand how to utilize that money. And other aspects are like if so it helps business in, so as a business scalability, you have understood that data has come a data AI and has been having a very important role in each businesses. So as an information system, which day-to-day business decision making, how that decisions of financial numbers are the major aspect. How much stock to buy, how many raw material to have, how many employees to have it, how many maybe customers you want, or how many marketing tools, vehicles, capex, opex, everything you need to understand. So numbers plays a very important role. So finance plays as an information system to your organization. You have better information system, you have better data to play for. And also, so you might have heard, business means risk. The other name of business is risk. And every day we have to take risk. But numbers helps you take that calculated risk. If you have those numbers in your mind, you can take calculated, okay, after 1 month I can do this, after 10 months I can do this, after 2 years I can do this. If you have those numbers in your hand, your risk is mitigated and you are taking those calculated risk. So, and another third aspect in understanding this is optimizing your resource utilization. So for example, you think, okay, let's have a business, I'll have that machinery which has 1 lakh units of capacity, 1 lakh unit production capacity on daily basis. But what you see is on an average basis only 50,000 can be based, because on the basis of employees. So if 50,000 capacity is waste. But then you go further and you go into market and see only 20,000 can be delivered because of the vehicle capacity or due to the transportation logistics region. And then you go further and you see that the market demand is only 10,000 units. So for only 10,000 units, you are planning now to have a capex expenditure for 1 lakh units. But it's not right. So that's why financial helps you understand, okay, if you have a lesser capacity, it's better to outsource rather than making it yourself and reducing your capital cost, heavy investment cost at the initial stages. So what is important? Why then financial planning is optimum fund utilization, capital structure, how your capital structure would be, how your operations will be, how you will control your finances, your business shocks like COVID happened. So many companies went down in COVID. Because there were no financial management planning, the certain situation happened. We assume it as a going concern. Everything is happening in that way. So investment, financing decision, so it actually connects your present to your future, where you want to go. Otherwise, you're just stuck in your present, you are just managing day-to-day operations. But if you have a proper financial management, it helps you go to the future. So it generally creates your roadmap where you want to go. So financial planning, in other way, we are talking about financial planning, but actually in business term, it's more of a financial management. So there are certain tools, I would say, which everyone should understand. There are 6, 7 tools, or there are 6, 7 concepts, I would say. So one is capital structure, cost of capital ratios, fund flow, cash flows, budgeting, and other concepts. So I'll just give a brief about everything in a minute about every aspect. What is capital structure? Capital structure, understanding how much equity you should have in your company and how much debt you should have in your company. So generally, if you will find, so generally if I have talked about multiple layman's whenever they come, so how much they say 100% equity should be there in a company. But if you'll go find the billionaires balance sheets and all, more than 75% of their capital is through debt, not from equity. Maybe 75% they have reached at a certain stage that they can 70, but at least you should have a 50% of your debt and 50% of your equity. It's not 100% equity is never viable because you are investing your money in one thing. You can invest in multiple things, and with that debt, you can have more money. So how much capital structure, in a sense, how much equity, how much debt, how much retained earnings, there are multiple other things, but major two aspects is equity and debt. So how much total amount you should have it, and then how much in equity and how much in your debt. So you have to find the optimum capital structure, which is, but generally it's not optimum, actually it's an appropriate capital. It's a realistic term in practical term. It's not optimum, actually it's the realistic term is appropriate capital structure. So but there are certain other situations also. It's not just like say if I've said, okay, 75% is debt, 10, 20, but there are other different aspects to it. For example, if you are sure shot in your business, if you're sure shot in your business that you will get 20% return maybe, by any means, your net profit will be minimum 20, then it's always better to go for a debt. Because, equity holder expects more return. They expect more return than 30% to 50%, to even in startups it goes 100% or 10x. But generally every business expects 30 to 35%. It's not 10 to 12%. Rather, your debt is only expecting 10 to 12% of your return. But that business is, so optimum capital structure actually helps you understand. But there are certain things, like if you're spending money on marketing, where you don't know what results will come in. You don't know where things are coming up, whether the small amount or higher amount, how things are coming up. In that marketing expenditure, then it's better to have equity, because where you don't know whether you'll get 20%, 10%, or you can get 100% out of it. So optimum capital also helps you understand that how things are there. Another concept which is called as cost of capital. But I generally say it's not cost of capital, cost of obtaining capital. That how much minimum return you should give to your investors so that everyone should come in, okay, I want to invest into your company. Optimum cost of capital in other terms, it can be said from an investor perspective, it can be said as a return of investment, but from a businessman who's taking that equity money, who's taking from you, who's taking from a debt. So it can be, again, which rate of interest, how much return is expected, how much. So that's why if you have to, it's a reverse calculation, that how much minimum profit I should have is weighted average of whatever I have to give to the other people, to the debt, to the equity. What is the average of that? That should be my net profit. If I'm not getting the net profit, I shouldn't going with that business. So that cost of capital is actually helping us in that's why. Another concept you might have, and even I'll tell you, all banks has only that parameter to give that loan, and that is ratios. Calculating that appropriate ratios, cause and benefit analysis in your balance sheets, in your profit and loss account, it tells you. So everyone goes to a doctor. Why they go to a doctor and they says, okay, go get the preventive health checkup done, or maybe get the certain test done. And you have seen those tests, your results, and what is the right number result you should have it. What is the number of, like if you have a maybe sugar, you say 100, so it says 100 is appropriate, but if you're getting 120 or if you're getting 150, 180, you're not doing it right. So ratios actually help every business understand those numbers. It's like a prescriptive. You should get those ratios done, and banks just see, they put they take your data, financials and all, they see what are the ratios, whether you'll be able to pay the loan back or not. They take those ratios into consideration, then they give loan. So ratios helps you understand. So it's like a periodical examination of your books, of your business. So you should on regular basis get your ratios done, and you should compare it with the different markets also. Maybe industry, like if you are into a manufacturing car industry, compare it with other manufacturing car industries. Even if your comparison with last year, previous year businesses, compare those things with them. If you will have those comparison, you will get better results, you will get improvement on daily basis. So, and another, so there is no standard list of ratios actually. Every author, every analyst, every investor, every person buying can have only few of the ratios. There are hundreds of ratios, but only few, 4, 5, they have a criteria where they go and use those ratios and all. So generally there are liquidity ratios, long-term ratios and all, so which you want to consider it. So the next concept is generally capital investment. You know, capital investment decisions are long-term decisions. Once you have put money and it has to go for 5 years or maybe 10 years down the line, having a building, having a machinery, having a project installed, making a bridge, making other things. So you need to see that capital investment, whether I'm investing that money, whether that investment is appropriate or not. So that capital investment decisions need to be taken care into mind before you are investing those things. Generally for what purpose generally you say? So for example, if you have a machinery, so now you want to get your machinery repaired, or maybe you are getting that machinery repaired every 10th day, so it's better to replace it. But how much money to be spent? We need to see those things and how it is reducing my cost. Whether I should make it myself or I should go to a person who's making 1 lakh units. I'm just looking for 5,000 units, and they just make those 5,000 units for me. It's better to get those because just in time I'm getting those. I don't have to go to any hustle and all making manufacturing. I'm just getting it delivered. So it's better to get your parts getting delivered, or maybe to your doorstep, and rather not making it. So expansion of existing, maybe you already have a one plant. Now you think I should go for another plant. So these are the certain things which you have, so that's why capital budgeting techniques are used. So where to invest long term, number of years, what is the return on investment? So that is an important factor. Discounting factor, net present value. So it says what is your return in your business, like it's 18%, 20%, 30%, and whether calculating with all those cash flows. It's not about your profits actually, it's more about cash flows which is considered. Maybe it is from selling a machinery itself. After a 3 years project, if you're selling a machinery, that is also a cash flow. So cash, managing those cash and those capital techniques is more important for decision making in day-to-day your life. So another concept which you have seen is fund flow statement. So everyone goes for profit and loss balance sheet. But profit and loss and balance sheet doesn't signify anything. It's done on accrual basis. Your sales, your books may show a sales of 10 crores, but in balance sheet may show that 5 crores is yet to be received in my books. So it doesn't show exact picture. And there can be a situation like you have profits in your business, but actually your profits are selling off a building. You're making maybe a water bottle, but actually your business in losses, and you have to sell one building and go on a rent. And by selling that building, you are getting 10 crores and a profit of 3 crores because the land appreciated. Your books is showing a profit of 3 crore rupees, but it's not a real profit. It's a profit from building, it's not from your operations profit. So fund flow statement actually helps you sources and application. From any source, any fund is coming, whether it's a capital, whether you have taken a loan, whether it's from equity or whether it's from sales, and where it has gone. Whether in capital, whether in equity, or whether in your purchases, whatever thing. So it helps you understand where my money is coming from, whether it's coming from, because so you will find many people in a debt trap. And the major reason is because people spend their short earnings for a long-term project or the long-term earnings to a short-term project. If you're taking a term loan, long-term equity for a short project, then your money is gone. You are stuck in debt trap, or maybe otherwise. If you're investing your short-term money for a longer-term project, you're taking a working capital loan for 2 months and putting in a 5 years project, you're stuck in that trap. So if you're doing those wrong decisions, then you're really stuck in that. So you don't have to take those decisions. Another which is important is, so you might have heard many companies saying that we are very good in business, we have assets, we have team of 1,000 people, but we don't have money right now. We don't have cash right now. Managing cash, managing your working capital is very important. So I'll tell you example. Sometimes one of the guys who said was selling an insurance, and the person said, no, I have 10 properties. If something happens to me, my properties are there to handle my family. I don't want insurance. But the person said, okay, you want your family to sell your assets once you're not there, or you want your cash 1 year, 2 year cash down the line, if you're not there to manage your family cash, education thing, to manage from that cash, or you want your family to sell those assets once you're not there. So managing that cash becomes a very important, that's one important aspect which gives you more, I would say, returns, or maybe your business is gone. If you're not able to manage cash, you have assets, but if you're not able to sell your land or building anything, but you're not able to sell your pay your salary to your employees are gone. They are there for if you're not paying salary for 1 or 2 months, they'll be gone. Managing cash, that working capital is very much important. If you are able to manage that, have that working capital, approved working capital, your business will be on day-to-day basis. You're able to, I would say, consistent, persistent. You will be able to go for long, and if you're able to consistent, persistent, your business can't go down. So that is very much important, that you should have that cash management, that cash flow. Though cash flow management as a concept is totally different. It manages from where your money is coming from, investing, operations and all. But cash management is more of a working capital management, where you're making budgets on monthly budgets, annual budgets, and those budgets are required. And once you have those budgets in your hand, once you have annual budget, but every month you have to review your budgets, that where my money is coming from. If I have my order, my payment are stuck, maybe due to foreign exchange fluctuations or due to many other 10 reasons, you have to manage those. You have to see now how and where to get those funds from. You have to manage those things. So financial planning, or maybe financial management, cash flow management is an important aspect which every organization should monitor it on regular basis if you want to have a sustainable and a profitable business for a longer term. Thank you so much.